Okay, let's continue on with inventory and purchases. We're purchasing here, we're gonna look at purchase returns and allowances. So on March 3rd, we purchased $1,000 worth of inventory. We did it on credit, so we have an accounts payable, a liability. So inventory is the asset, assets increase with a debit. Accounts payable is a liability, it increases with the credit. The terms associated with this purchase are 110 net 30. This is what we've negotiated, or these are the standard terms with this company that we're doing business with. And so we'll get a 1% discount if we pay within 10 days. The net amount is due in 30 days. Now, we're looking at returns and allowances. What this means is occasionally we might not be satisfied with this, and we may return some of the inventory. Okay, so let's say in this example that we're returning $300 worth of inventory. Well, all we do is we just reverse out the entry for the dollar amount that we're returning. So we're returning $300 worth, so we're going to, instead of crediting, we're going to debit accounts payable and credit inventory. So I hope you can see that the balances in these accounts are now going to be $700. Our inventory will now be recorded at $700, and our accounts payable will also say that we owe $700. Because we had a return. We actually returned some of this inventory. Okay, so that's the return portion. The allowance portion. Sometimes we may be dissatisfied with part of the inventory. Maybe it doesn't work right, whatever the reason might be. Occasionally customers are dissatisfied with the item. They'll call the seller up and they'll inform them of their dissatisfaction. Well, sometimes what happens is the seller says, well look, I'll just reduce the price of it. Okay, so let's assume that we have this purchase of $1,000 and we owe them $1,000. So the inventory's at 1,000, accounts payable's at 1,000. We're not happy with the quality of the materials of this inventory, so we call them up and they say, look, just keep it, we don't want you to return it. What if we reduce the price by $300? Okay, you might say, oh, okay, if you reduce the price by $300, I'll just keep it. So for an allowance, you do the same entry as a return, except you're just reducing the price of the cost of these items on your books. So you reduce accounts payable by $300, bringing it down to $700, and then you reduce inventory by $300, bringing it down to $700. So the entry is the same, whether it's return or allowance. A return, though, is you're physically returning the inventory items, and allowance is you're just getting a reduction in the price that you're paying for it. Okay, but it's the same thing, the same journal entry. Now, let's say whether this is a return or an allowance, let's say on the 13th, it's now time for us to make the payment. You've got to realize that you get the discount not on this $1,000, it's on the net amount. So it's only the $700. So what's going to happen is, hopefully you can see this, is we need to reduce our accounts payable by, hopefully you see, by the $700 because our accounts payable is $700 now. Okay? The cash we're going to pay is, well, 1% of 700 is $7. So we're going to pay $693. So we will credit cash $693. And then the last entry is to inventory for the $7 to get our journal entry to balance. Okay? So notice that our inventory was 1,000. Then we had this return or allowance for 300, so then it's 700. Okay, but we're going to reduce it another 7, so it's 693. Where else do we see the 693? Well, right up above. We want our inventory recorded at the cost that we actually paid for it. So this reduction of 7 in inventory brings our inventory down to $693, just what we paid for it. Okay? Good luck with this.